single company in venture, there's a high risk of losing total money, right? So the total loss risk is quite high, and the partial loss risk is also quite high. And a single fund total loss ratio is low, partial loss ratio is still there. In a fund of fund, total loss and partial loss ratio is more or less zero. I think it's 1% for partial loss and 0% for total loss.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast, and today we have Ertan Can with us. Ertan is a venture capital fund of funds pioneer in Europe and founder of Multiple Capital, a fund of funds focusing on micro funds, emerging managers, first-time funds and solo GPs. He has combined 20 years of experience in asset management, fund of funds, VC and information technology operating roles. Now they're deploying out of their Fund 3 at Multiple Capital. In this episode, we talk about the focus of the new fund at Multiple Capital, fundraising tips for GPs and founders, and the majority focus of this episode will be on comparing fund of funds with VC funds from an LP perspective on different fronts like return profile, risk profile, diversification, management fee, fund duration, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called PodcastX, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Ertan, so good to have you on the VC 10X podcast again. How you doing?
I'm very good. Thanks for having me, Prashant.
Absolutely. And you're the first guest that's coming on for a second time. So that's a first for the podcast.
Cool.
All right. And there's also an occasion where you have just raised another fund for Multiple Capital, which is a fund of funds. Many congratulations on that, on the new fund. And tell us more about it.
Yeah. So we have started raising our third fund within the last 11 years. So Fund 1 and Fund 2 is fully deployed. We have invested in 44 funds in the last two funds, and Fund 3 is like the continuation of what we're doing with the exact same thesis and strategy. And we started last year. We did its first small close. We have started deploying, investing into funds. We think that the current ecosystem is extremely interesting in terms of deal flow. That's about that. So the fundraising part, it's still a tough one, I think, for European fund of funds in general. I think we have a benefit because we are not raising large amounts. So we are, as you know, a micro VC focused fund of fund, and we don't need large amounts to make it happen. And we consider ourselves like a micro VC or micro fund of fund. So that helps. We don't need a lot, but at the same time, it's still a very difficult fundraising environment, and it was last year even worse. I think it's getting somehow better. So 2024 seems to be, after 3 years of difficult fundraising situations with COVID first, and then the war in Europe second, and latest the interest rate increase in the European ecosystem, which is, I think, one of the probably even the worst effects on fundraising for private equity and venture capital. It seems to be, how do you say that, everything is priced in, and people are also expecting lower interest rates now, or falling interest rates, and that could help the whole ecosystem. So we are more positive for this year in terms of fundraising, and I think in general the constant capital in the European ecosystem, like the government LPs, were still actively deploying. So that keeps at least one part very constant for emerging managers or in general VC funds.
Absolutely. So this has been like a very probably one of the most difficult times to be raising a fund, and it's more or less the same for startups as well. So do you have any tips on fundraising? How maybe the founders who are raising funds or GPs are trying to raise their funds. Any tips on how they can do it better?
So I think a lot of GPs have learned in the last years, and I think the whole ecosystem has improved. So in terms of fundraising, everyone acts more professional than, let's say, 5 to 10 years ago. That is a plus. So everyone has a better understanding on, who is a right LP, who is a good match, identifying the LPs. LPs are much more transparent. There are many more LPs in the market. Most of them are raising capital at the same time, but at least there is an intention of, more fund of funds being created in the European market. I'm talking mostly about the European market. So these are all good signs. Now, how can they improve the fundraising environment or the fundraising their fundraising journey? I think one thing that should be part of any emerging manager who wants to raise a fund is resilience. It's a very long-term game we're all in, and not only that, the fund will be a very long-term game. So it takes on average 12 to 15 years to pay back a fund in venture capital, but also the fundraising journey is for most of the emerging GPs, in most cases, a journey of 2 to 4 years. So, from the first idea, first pitching, until you have the final close, it can take up to 3, 4 years. In many of our portfolio funds, this is the case. So I think resilience is extremely important. In Another thing that I think helps is to be very consistent in your thesis. So if you believe in something, don't switch every year just because there is a new trend. I think that is not helpful. At least for LPs like us, it is not helpful. And I think it's also not helpful for yourself or for the emerging GP, because it will be short-term money that you will raise from this kind of from this kind of trend moves. So for us, I think it's very important to be resilient, to be focused. So if you have pitched me something 2 years ago, it should be ideally the same idea, same focus, ideally with some investments done, warehouse sometimes if you haven't done a first close. So that is maybe the two things that I can say.
Absolutely, that's helpful advice right there. And uh, since we are here, and you just mentioned that it's a micro fund of funds, right? So it's not like a huge amount of capital that you're raising there. So if we try to compare your fund of funds, which is a micro fund of funds, investing in
Mhm.
micro funds, if we compare that to a sizable VC fund, right? Since one of the motives of this episode is also to make a solid case for fund of funds, right? So let's do that kind of comparison, that the same size of venture fund and the similar size of fund that you're running,
Mhm.
how would that compare in terms of return profile? For example, let's say it's $100 million fund, right? hundred
Mhm.
million dollar, right?
Mhm.
So how does that compare to return profile, risk profile, diversification, access, all these aspects? Let's try to compare these.
Yeah. So 100 million fund, or in general, a VC fund versus a fund of funds. What's so to compare it, I think a VC fund has always one strategic focus. In our case, we believe in funds that are either geographically focused or vertically focused. Now, if you're geographically focused, let's say you're focused on the German-speaking area, So yes, you will be, investing and finding ideally the best companies in Germany. Now, if the biggest outliers were not in Germany but in the Nordics, you will miss out because you're not investing into the Nordics. The same for vertical funds. Let's say you're a fintech fund. So yes, you might invest across Europe in fintech, and if there are great companies in the fintech ecosystem, you will probably win if you're a good fund, right? But if, let's say, the next generation of super outcomes are life science companies, you will miss out. Okay, this is the kind of I think the spread in a single fund is just, by basic math, is just wider. What does it mean? A single fund can be underperforming if they are wrong in, with the thesis. Let's say fintech again, or one specific geography. Uh, But if they are right, of course they will be extremely overperforming compared to a fund of fund, right? So now, looking from a fund of fund lens, the fund of fund is more diversified in the end. So we are not only picking one vertical, but several verticals. Let's say in this case, again, fintech and life science. And we're not picking only one geography, but several geographies, so that we don't miss out. So, for example, in our case, I think I've mentioned this a few times, the biggest outlier in our portfolio is from Romania. Romania is one of, one country of several in the Eastern European region, and no one expected this kind of mega outlier out of this country. So if we wouldn't have allocated into that region, we wouldn't have allocated into that company. I think that is super important for our strategy, and there are several funds who claim to have like access everywhere and all verticals. We think it's just very difficult to have that from a, from a single fund level. We have even a slide, I think we compare like a single team of 3 4 partners, and then we have in each fund of fund 70 partners. So it's like it's an unfair comparison. You need the 70 people who are incentivized and specialists either in the region or the vertical to really be able to allocate in the whole ecosystem. In our case, European ecosystem.
Absolutely, totally agree. And that's an interesting case of Romania there. So can you give us more details there? How big was the fund, and was it only Romania focused fund, or was it investing outside as well?
No, the fund we've invested in was a 150 million US dollar fund. It's probably the largest in our portfolio. The thing is that back then, this fund was covering Turkey and Eastern Europe. And people forget that back then, so it's now 7 8 years ago when we have backed this fund. This fund, there was literally no fund in the region, or very, very few capital in the region. So the fund did not only the seed rounds, but they backed the companies in most of the cases as a lead investor, also in the A rounds and the B rounds. So it's one of the very few multi-stage funds that we've done. We don't think that multi-stage works in most developed regions, including Eastern Europe today, right? It's very difficult because there's much more capital available for A and B rounds as well, and the capital is now also outside of the region is available in the region, so it's much more competitive A and B rounds in the region. But back then it was, in our opinion, a good strategy to have a fund that is larger, because they have to be larger, otherwise the companies would not have enough money in their A and B rounds. And this fund ended up owning, sometimes 40% of the companies, which is very unusual. None of the 150 million funds in London or Berlin would own 40, 50% of the companies after their Series A and B. They would be diluted to 10% or 15%. So that was like one of the biggest funds. And because of that special situation in Eastern Europe, they could cherry pick at seed stage, follow one on A, follow one on B, and that created one of the best picks. But again, like you need the outlier in the region, right, to so that something like this can happen. If there is no outlier in the region, it might be, very average fund for us. But that is our bet. So another outlier is for us in France. So again, we didn't expect that. We are relatively agnostic when it comes to geography and vertical. So we don't know where the next outlier will be created. Because of the diversification, the probability is relatively high that, our net just gets one of those outliers in the region.
Absolutely. And going back to the comparison we were making about a VC fund and a fund of funds model from an LP perspective, right? So you mentioned about how you can miss out on a lot of stuff if you're investing directly into a fund, because a VC fund is likely to be focused on a particular sector or a particular region, while a fund of fund is a lot more diversified in that respect, right?
Correct.
And also talk about the risk profile, right? So what I read in your report is that a VC fund is more likely to go in a loss or not return your money, as compared to where there's close to zero probability that a fund of fund would go negative on your investment. So give us more view into that.
Yeah, there's even a statistic about it. So that there's statistically almost no probability of a fund of fund losing money, right? So there's two things here: losing all the money, like a total loss ratio, and a partial loss ratio. Now, a total loss ratio, even in a single fund, is almost zero. So there's literally no total loss risk in a single fund, but there is a partial loss ratio. So in a single fund, you can still, for example, return like 80% of the money you've invested in, right? You would have lost 20% of your money. So again, losing all the money is almost not possible or very, very rare. But losing 20, like losing part of your money is still quite happening in the venture ecosystem. That's, you can compare it to a single company. A single company in venture, there's a high risk of losing total money, right? So the total loss risk is quite high, and the partial loss risk is also quite high. And a single fund total loss ratio is low, partial loss ratio is still there. In a fund of fund, total loss and partial loss ratio is more or less zero. I think it's 1% for partial loss and 0% for total loss. So you reduce the downside. At the same time, of course, your upside is limited, right? So again, if you're a top fund, you can be a 20x returning fund, right? A fund of fund 20x returning is almost impossible, right? It's like it's, but you can compare it also to a single company. A single company could be a 200x return, right? But a single fund, it's very impossible or almost impossible to return 200 times. So it's like it breaks down. It's the same thinking. What we are doing just is, a single fund can be still like, if you're just choosing one single fund, it could be still that this fund is not really performing well, right? Um, Whereas in a fund of fund, the probability is just very low that we're not performing well. So, and the reason for that is in venture, there are outliers. So for a fund of fund, I think without having outliers, you will be always somewhere in the middle of your portfolio. But having outliers makes early stage venture in, fund of funds in early stage venture. As soon as you have an outlier, we become one of the best portfolio returners in our own portfolio, right? Because there is a 10x or a 15x returning fund, and that moves us up the ladder, and we are better than 90% of our own portfolio. This is, I think, quite unique in venture capital fund of fund compared to all other asset classes. Because if you think about, for example, private equity or hedge funds or real estate or infrastructure, there are no real outliers anymore. In these asset classes, the return expectation is always very limited. The range of returns is very low, and that's why without outliers, the fund of fund is always somewhere in the middle. There's no potential for a fund of fund to have outlier returns. Now in venture it's different because of the potential outliers, which happens more, and realistically the fund of fund can benefit from that outlier potential of single funds, or we are talking with about 10% of our funds. So if we do 30 fund investments, three of them we expect to have really strong returns. Now those three make us number four. Now, if you are able to pick those three, then you don't need a fund of fund, right? So it will be great. But the thing is, even we don't know which of those 30 are the three, because all of the 30 that we invest in have more or less the same potential to be an outlier fund. Which ones they will be, we don't know. And that's why we do 30 fund investments in 3 years, right, across Europe, to be able to pick ideally three of them or 10% of the portfolio to be outliers. But as soon as we have, three of them outliers, we are number four, and 90% of our portfolio, which are all great funds, will perform less than us. And I think that is the beauty in early stage venture. We went very deep now, but I think that is the real beauty in venture capital fund of fund modeling, that the probability for us is high to be number four in a high performing portfolio.
Absolutely. Yeah, yeah, totally love that comparison and explanation you gave there. And also, there's one thing that's often held against the fund of funds model, and that is the fund duration, right? That it is a 12-year duration that the fund
Hmm.
is, and it's as compared to the 10-year duration of a VC fund, right? So, what do you
Yeah.
say on that?
And I get this question very often. So I always try to explain that, if you are investing in a single company, not even a fund, the duration of that single company in early stage venture is probably like 5 to 10 years until you can exit the company. Now, if you have a fund, that fund tries to exit all companies after 10 years, right? So let's assume we're like taking the basic model. So if you want to invest only in one single fund, then your duration is 10 years. But if you would invest in several funds or several companies across years, right? So not only this year, but next year as well, and the year after as well, the total duration of this portfolio. So let's say you invest in one fund this year, one fund next year, and one fund in year two and three. Your total duration is exactly the same as our duration because the last fund you have invested would be in 2 years, and that will be another 10 years because the last fund takes another 10 years. So it's the same thing for us. We invest across 3 years, three vintages, and that in the last vintage we add will lead to a 12-year duration. But what I'm trying to say is there is no way around. If you want to deploy across vintages, there is no way around this duration. So you have to accept the duration, the longer duration. Either you build yourself, like a company, you invest in companies over 3, 4 years, or you invest in funds in 2, 3, 4 years, or you invest in one fund, the fund that invests over 3 years. So it's the same thing. We try to diversify across three vintages with each fund of fund because we don't know which vintages will be the best. We are continuously trying to invest in every vintage, and that leads to slightly larger fund durations.
Right. Absolutely makes sense. And another important aspect of this is the double fee structure that's there in the fund of funds model, right? That you have to pay the fees to the VC funds that you're investing in, and the LPs that are investing in you also have to pay the fees to you, right? So it's a double
Correct.
fees there, right?
Correct.
So
I'd like
what
to
do you say?
start with an anecdote. 10 years ago, when I spoke to a lot of European managers, they had, by the way, a similar discussion with family office when they raised 10 years ago, because the family office said, "Why would I pay fees to you? I can invest directly into companies myself without the fees." Until they realized it's not as easy and it is not as cheap as they think. So I think that is the kind of realization that maybe comes also to Europe. I think in the US, for example, the double fee layer of fund of funds are very much accepted by many institutional investors just because it adds value. And I think in Europe, there's still this mindset that, why would we pay a second layer of fees? We can invest into the funds ourselves. Now, we always try to make a very realistic example. So if a lot of family offices invest only 1 or 2 million in us. So to have a diversified portfolio. Now, if you look at the 1 million at a 1 million investment, the fees attached to that 1 million investment, we take 1%, would be 10K a year, right? So for 10K, $10,000 or euros a year, it's impossible to build what we are building, right? It's like not possible to have this kind of portfolio for 10K a year. That's, I think, the simplest explanation on why, at least for those smaller checks, 1 million, 2 million, 5 million, it's almost impossible to build more cost efficient a model like a make or buy model. It's always a make or buy model in the end. So even up to 10 million would equal to 100K fees a year. I think it would be quite hard to build something similar that we are doing with our work with 100K budget every year. I've worked for a family office before, so I know that the costs I had in that family office were much higher compared to the same commitment the family office would have done in a fund of fund. Now, at some point it makes sense. So I'm not saying it always doesn't make sense. I think we think like at 25, 30 million, there's kind of break even, right? So, and if someone wants to allocate 50 or more into venture, it can really make sense to have an internal team and that might be cheaper, right? So the lower costs. But I'm not talking about quality. So it would be still you still need like the right people to do the right job, right? So one thing is the make or buy decision, just comparing costs of a fund versus an internal team. The other thing is, are you able to attract the best people in your internal team to do venture, to do what we are doing? That is a question I can't answer. I think some will be able to do that and others will not. But that is the real answer to this question. So I think again, you have to compare on what you are going to invest and how much you're going to invest, and if that's realistic, that you can really do it better and with lower cost internally compared to a fund of funds. And I think in most cases, for most LPs that we are talking to, so checks between 1 million and 10 million, uh, in my opinion, cost-wise, it doesn't make sense to compare it. It has not lower costs to do it internally. If you really want to build something that we are building, so investing into 10 funds, looking at 600, 700, 800 funds a year, building a thesis, building a brand, all these things take resource and money, and it's not easy to rebuild that with very low costs. And one more thing, maybe to add on the double fee layer, we see now more and more funds. Some of we don't know exactly about the established funds, but I think there are several rumors that very established big brands take much higher fees today, so they can take up to 3% and 30%. So instead of the 2 and 20, they go for higher management fees and higher carry. So the total fees in some of the established funds are much higher than people think. Plus, a lot of LPs use feeder funds to access those established brands. And each feeder fund, if it's created by a company, by a placement company or bank, has their own costs. So the total cost of investing into established funds are sometimes similar to a fund of fund model. You know that there are several of those new companies where they give you access, democratize access to large PE funds. Now people forget that this is like a double fee layer that you pay to enter a large established brand, and they accepted to invest in a single fund with these similar fees like a fund of fund without having really a portfolio selection or portfolio that is built there. So I think that is one trend that we see, that established funds have higher fees. And if you compare that to a fund of fund, then the fees would be rather similar. And the other trend we see is that some of the emerging managers, some of them tend to ask for up to 30% super carry. And that again is like the cut that we have, the 10% plus 20% of a fund has 20%. And that is also some kind of trend that we see, 25, 30% in many emerging managers. When they can, they ask for super carry. And a lot of funds have 2.5% management fee in the US, for example, right? So if they are small, the US in some places seem to be a more expensive place to live. Emerging managers justify having 2.5%, and there's a trend of having the 2.5% over the whole lifetime of the fund, which equals to 25% management fees. Now, the average in our portfolio, the funds have 17% management fees. The 17 plus our 10 would be around 27, whereas some of the emerging managers get 25 upfront, or 25 total in
Yeah.
just one single fund. So I think the fee discussion is multi-layered and it's very
Yeah.
detailed. And I'm always happy to discuss this. So I think it's an important topic, but it's also very often misunderstood. And if you compare the potential outlier returns that a early stage venture fund of fund can create, it is totally justified to have the double fee layer.
Absolutely. And another key aspect to consider here is the administrative hassle that the LP would face if they were to do it by themselves. You mentioned that some of them can potentially have it at a lower cost by doing an internal team, but the kind of hassle that they will need to go through still, if they are looking to get the kind of diversification that a fund of funds gets them by investing in different regions, different geographies. Uh, that would be, I think, a big hassle for them to do it in house. So
Correct.
that also adds to the point for the fees.
Correct. So here again, with an example, I think we have invested in more than 10 jurisdictions.
Yeah.
Delaware, Germany, UK, Jersey, Guernsey, Luxembourg, Estonia, Finland, Netherlands, BVI, Cayman. So it's like and we expect more regions to come. And I think many people underestimate the administrative hassle behind investing in different jurisdictions and the whole tax compliance part of doing that. And again, like if you really want to build something that we're building, you would need probably something like 3 to 5 million by the investment checks that you have to do in each fund. And because if you would do like 100K checks in each fund, it would be 3 million if you do 30 investments. And for 100K investment check, you wouldn't do a legal or tax due diligence or would build blockers around that and all the things that are needed to really make it operationally efficient. I think that is also very often underestimated, which a fund of fund helps to solve. A fund of fund would be one investment for a family office or an individual or an investor, whereas the equivalent to a fund of fund would be 30 investments, yourself that you're doing in maybe 5 to 10 different jurisdictions. Now, some reduce that risk by investing just in one jurisdiction. You see that very often. So, for example, the German family office then tends to invest only in German funds. The UK family office tends to invest only in UK-based funds because it's easier and there are some tax benefits from the government. But that reduces again the kind of diversification that we would, recommend to have. So it doesn't help a German family office to invest only into German funds if they really want to allocate into venture. So venture is a pan-European or even global thing. So if you really want to allocate into venture, you have to have a global portfolio and not only a Germany-based or Netherlands-based or UK-based portfolio. I think that is something, it's kind of solution for the problem. Well, if it's complicated to invest internationally, well, then we do only local funds, and I think that's not really a solution to the problem. It's maybe a fake solution to the problem.
Yeah. Absolutely, yeah. I think we have made a very solid case for fund of funds here. I think the problem at this stage is still that fund of funds model is also very early, especially in the European ecosystem. So I think the awareness aspect also needs to be there, and I think this episode is going to be very very helpful for those. And now with the new fund, do you have any changes in strategy of what's something new that you're trying to do with the new fund? Any changes
Yeah.
there?
No. So I think we still think that the original thesis that multiple had to invest into what we think, are micro and in the US may be called nano funds meanwhile, but funds that are 5 to 50 million in fund size, on average investing into 20, 25 million fund sizes, that invest again at seed stage across the European ecosystem. I think that is exactly what we want to do also with the next fund. The only difference is I think that we have increased the 500 average check to a 1 million average check. So we're still not too big or too small to do exactly what we do. So 1 million check and a 20 million fund is still significant enough, but not too large or too small. So it really helps to continue exactly the same model. I'm now in year 11 in terms of track record. And I think when also like I'm looking at a lot of VC funds, right? So that's my bread and butter. And I think there are very few funds with a very, very consistent long-term thesis that is exactly the same. Most funds that were successful in their early funds are raising much more capital in their new funds today. So the thesis by that is already changed, right? Just because you have to deploy more capital into the same kind of companies, you're not a pure seed fund anymore, for example. So I think it is super relevant to be extremely consistent if you believe the thesis still makes sense. We believe that our thesis still makes a lot of sense for us. The only thing I think the small difference that we had like a higher allocation to US funds in the last fund, and I think we will concentrate more on the European ecosystem with this fund. And we still will do like 20% outside of Europe opportunistically, but our what we realize that we are the the that we are much more specialized on European managers and have a better access and also see everything that is relevant for us in the European ecosystem, whereas outside of Europe, it's really opportunistic, and that should be not really a core part of our strategy. So I want to be less opportunistic and more focused, strategic, and that is maybe the only small difference between Fund 2 and Fund 3. But in general, it's the same thesis, same strategy, more or less same ticket size, slightly higher. same kind of portfolio. Last fund we had 34 fund investments. We're now planning to have 30 to 40 fund investments. So doing 10 to 12 commitments every year, every vintage. So it's really trying to keep it extremely similar to the last funds.
Yeah, that's amazing. And within your portfolio of funds, especially right now, how are you seeing the funds react to the current times? Is there a slowdown in how the investing is happening? Is there a pause? Maybe some funds are practicing a pause on investments. So how do you how are you seeing your portfolio funds play that out?
Yeah, that's clear. So we just had I just was on an AGM call before that. So there is a slowdown of investments, right? So funds have invested much quicker 2 years ago, and they have slowed down in the last 1 or 2 years. So 22, 2023, especially 23, I think most funds invested slower, which is not too bad, right? So I think there was a time in 2021 where funds called very, very quickly. So we know that we are working with capital calls, and funds called much quicker than expected. And now it is like it has normalized again, and that is also a benefit of a fund of fund. I think that these kind of single vintage things can be normalized over several vintages, and it's less relevant if there is a peak and if there's a down cycle. Because for us, again, even 21, to give you another example, not only funds invested much quicker, they also had much higher valuations in 21. Now they invest slower, but they have also lower valuations compared to 2021. And on average, for us, it's again totally okay. The average is for us more important. That's why we invest over time and in different regions. And again, looking at total average, it looks again very, very solid.
Absolutely. Yeah. Looks pretty amazing. And with that, we'll come to the close of this episode. So can you let our listeners know where can they go and follow you and your journey with multiple capital?
Yeah, absolutely. So I'm most active, I think, today on LinkedIn. So that's a good way to follow what I'm saying about the market and posting, and I'm quite active. So and then Twitter is the second channel where I'm relatively active. I'm speaking regularly on conferences across Europe. So almost every 2 weeks, I'm speaking on a panel, most of the time about emerging managers, fund ecosystems, venture in general, and early stage. So that is also a way how I communicate in the end. So just this week I was in Sweden at Tech Arena, which is one of the largest tech conference in Sweden, speaking about being an LP in emerging managers. That's the three ways. And if someone, we have an open policy. If someone wants to reach out to us with a new fund, the best way for us to reach out is to go through our website. We have a contact us button, and you will lead to an Airtable. It's like a 5-minute questionnaire that you can fill out, and it really helps us because the whole team has access to it, and we have the most relevant information for us would be answered, so we can do a much quicker selection and give much quicker feedback if it's relevant for us or not.
Absolutely. Thanks so much for doing this, Ertan. This is a very valuable and insightful episode for a lot of people who are especially looking to gain awareness about the fund of funds model and maybe looking to deploy some capital there, and multiple capital can be a good option for them. Thanks so much for coming on, and happy investing.
Thank you so much for having me. Thank you.